Good morning or good afternoon, depending on which side of the country you're joining us from. Thank you all for joining us today. Super excited about our presentation. We're going to talk about employee benefit pre-funding accounts and charitable donation accounts, which are primarily used in the credit union space. We're also, relative to this and very similar, are actually investments made in bank holding companies, which can create the same outcome. So really excited for all of our attendees joining us in. I know everyone's rolling in as we just reached the top of the hour. So thank you again for joining us. Should we go to the next slide, Zach? Really excited. I'm Charlie McQueen, President of McQueen Financial. We have three main areas of business here. We have a valuation team, which does transaction advisory and valuations of businesses and mortgage servicing rights. We have our asset liability management division, which has asset liability management reporting, interest rate risk, CECL, and all sorts of additional reports, such as liquidity today, which is obviously a very important thing. And then our third group here is headed up by one of our presenters today, Craig Cecilia, who leads our investment advisory business. And also we have Zach Whaley with us, which I'll introduce in a second, which is part of the investment advisory team. So thank you, Zach, for flipping it over. But Zach's one of our senior investment advisors. We're really excited to have him here. Zach specializes in working in the alternative space, as we refer to it, charitable donation accounts, employee benefit accounts, and bank holding company investment areas. So thank you, Zach. You've come here with a lot of experience and great information. So thank you, Zach, for joining us.
Thank you, Charlie. Did I cut your Craig introduction short there?
No, we can go back one page though, because that's just a great picture, and
It is a great
I want to
picture.
share it with everybody. So I am excited, and you pops, I rolled with you there, but
Right, right.
and I do want to thank Craig for being here also as Zach. Craig leads our investment advisory business, which oversees the alternative space, the EVPA, CDA, holding company, bank holding company investments, and our standard investments, and also our credit team. So all sorts of really important things. Craig oversees about $16 billion of investments today and credit, a large number of credits, we'll say that. So thank you, Craig, for being here and spending some time with us today.
Yeah, you betcha. You're welcome. And today you're going to hear a lot of Zach. As Charlie mentioned, he oversees the entirety of our alternative portfolio space, is doing a great job. I'm really going to be some color commentary for him, right?
That's right.
It's a lot of great information in this 201 webinar that we'll be doing today for alternative accounts.
All right. Well, as we go to the next slide, I'm sure you're all going to remember that we're going to call Craig Cotton eventually here. If anyone remembers the Ocho, great movie reference there to dodgeball. So,
Here we
but
go.
with that, you got to set you guys up on a great level to kick things off, literally kick things off or throw them at each other. But hey, a couple quick things. We are recording this webinar. If you'd like to have a copy of it, please reach out to your MFA advisor. We'll be able to share it with you. Also, it'll be on our website and also our YouTube channel. So really great stuff there. Also, if you move your cursor to the bottom of your screen, the little bar will pop up. There's a Q&A area. Please use the Q&A area, not the chat area, because we're not going to be monitoring the chat areas closely. But if you have any questions along the way, please put your Q&A or your question in, and the team will answer it either at that moment or if it's coming up at an appropriate time. So with that, thank you again all for joining us. I'm going to hand it off to Zach to kick off the webinar. Thank you, Zach.
Awesome. Thank you so much, Charlie. Really appreciate it. All right, Craig, you ready to get started?
I'm excited, actually. Absolutely. We've got a little bit of a theme going on today, make some analogies between, what's kicking off each section, which I'm excited to talk about that. Absolutely.
Yeah, we had a good setup with the dodgeball. People that are listening are probably wondering what we're talking about. We're about to show you, so we're gonna have some fun. So let's get started with a look of the overview of what we're going to cover today. And we can see that we are going to do a recap. We have several 101 webinars, and they're awesome. As Charlie mentioned, you can go see those on our YouTube channel. And we're going to do a little bit of a recap. So if you haven't been to the 101 and you're thinking I'm going to be adventurous and go into the 201, that's awesome. You're in the right place. We're going to bring you up to speed. And we're going to go into probably one of the most requested categories of questions that I hear, which is accounting. And we're going to get a little bit into accounting, even though, spoiler alert, we're not accountants. But we're gonna guide you in the right direction. We're gonna do a strategy deep dive, talk a little bit about reporting, give you a vision of what it takes if you're interested in one of these accounts, what it takes to start, and go all the way through the process to opening up the account. And then finally, we're going to address concerns. And we have in parentheses right here, especially liquidity, which Charlie also alluded to. If you happen to be on this call and you're thinking, I would love to be into one of these accounts, but I don't have any cash, I don't have any liquidity, that's okay. We will cover that. And there's actually very tangible things that you can do about that. So without any further ado, Craig, unless you have anything to add on here, we'll just get it moving. All right, so here we go. We have a 101 recap of the EBPA. And Craig, who are we looking at here? Do you know this guy?
I don't know him by name, but some repeating name keeps coming to mind.
Yeah,
Bueller,
right.
Bueller.
I believe it's Ben Stein.
That's right.
Is that right?
Yeah, that's right. And he
There
gave
you
people
go.
his money, I think, too. Is that right? Ben
Oh my
Stein's
gosh,
money.
now you're really going back.
Sure.
That's awesome.
Absolutely.
So yeah, the relevance here, if you're wondering what the heck we're talking about, we want to make it a little fun. So here's a movie reference, but he had the Bueller scene. He's teaching in front of the class, and he couldn't find the main character because he was off in bed, sleeping, taking the day off. So if you took a day off when we actually went over the 101, we're here to bring you up to speed, and hopefully a little bit better than this guy did, because he has a tendency to put people to sleep.
Well said. Great correlation there.
There we go. So, all right, what is an employee benefit account? And the full name is employee benefit pre-funding account. We're going to try to use as few acronyms as possible, but forgive us in advance. We're going to say EBPA a lot. It's just a lot easier than saying all that. But what this is essentially, it's just like the name sounds. It's an account that the NCUA allows you to open as a credit union to direct some of your excess liquidity into investments that you are not normally able to invest in your standard portfolio. And the purpose of these investments is for you to cover benefit expenses, just like it sounds. Pretty simple. So to get into a few more details, this is really the high level. If you want to understand how these accounts work, you need to know these bullet points, and they're not that complicated. So number one, you can invest up to 25% of your net worth in these accounts. Now, I want to really make note of that. This is really a guidance number. This is not hard coded anywhere in regulation, the 25%. We have seen this in examiner handbook where they would prefer you to be under 25%, or you get a little bit more scrutiny. There are examples when you might want to have more, but we'll save that for individual conversations. So you can take up to 25% of your net worth, put it into an account where now newly permissible investments are able to be purchased. The reason why we would consider these newly permissible investments is because you can earn a higher yield than investments that you would have in your standard portfolio. That's the entire point. And if we can earn a higher yield with these new investments in this special account, what we can do is we can increase our earnings, and especially compared to standard investments. Or even sometimes loans, which we'll talk about that more later. And you can use that increased income to offset your benefit expenses. So this is a great account, Craig, right? We're seeing a lot of people utilize these right now, and a lot of benefit to a lot of folks.
It's one of the biggest growing asset classes on institutions' balance sheets. And it has been for 3 years now, is the growth in that sector and people adopting these types of investments.
That's right. Really seeing it skyrocket as the knowledge of the regulation, the accounts are getting more widespread. All right, so let's jump into the next portion of what we're here to talk about, which is the CDA. Who is this guy?
I just know him as a rock and a roller, right?
Yeah,
Jack Black, right?
Jack Black.
I love the rendition that he does when he's doing some AC/DC, quite frankly. It tells you a little bit about my generation.
There you go. That's awesome. I've seen some of that. He has like a flute machine that he uses. That's pretty funny. But all right, so what's the correlation here? Obviously, he's teaching. We're going to teach a little bit about the CDA, but I thought this was appropriate because the charitable donation account is really one of, Craig, you always say it's my favorite account.
Absolutely, because it's basically about our mission, right? As an
Yeah.
institution.
That's right. That's right. So
Right.
it's fun. It's we can get out and kind of affect our community. And so we're gonna have a little fun here with Jack Black and talk about the CDA. So I love this because, as you just mentioned, Craig, the purpose of the credit union, if you really think about what your mission is to serve your community. And you do that primarily through giving great loans to your members, through offering great savings products, and also education, giving your membership knowledge. But beyond that, a lot of credit unions really want to have an impact in their community beyond their membership. And the way that you can do that is by having an impact to charitable organizations near you. They could be national too, but I find a lot of people want to really impact that local, YMCA or the local food kitchen or something like that. So this charitable donation account, what is it? It's an account just like the EBPI, the employee benefit account, where you can take a portion of your excess liquidity and put it into investments that you are not normally allowed to buy in your standard portfolio in order to achieve a higher yield. And really, we go into that on this page. So the regulation here is 5% of your net worth. This is not guidance. This isn't, hey, it'd be nice if you stayed under 5%. This is, we definitely want to keep the portfolio size at 5% or lower. And within that account, you're allowed to invest, like I said before, into newly permissible investments, increase yield. And when we look down here at this bullet point, we get into some of the specifics of the regulation. And we want to educate you. This is 201, so we're going to get a little bit detailed here. Depending on the state that you're in, the charter that you have, I should say, whether you're state chartered, depending on the state, or whether you're federally chartered, you're required to give anywhere between 51% and 100% of your earnings to qualified charities. Now, if you're wondering, what about my state? Let's talk after. I'm sure people are tempted to put it in the Q&A, probably better after. Let's make sure we look at the regulation. But 501c3 charities are one of the categories that fits into what is considered a qualified charity. And that's really what people are typically, when they think of a nonprofit organization, they think about a 501c3. But Craig, new this year, right? This is hot off the presses.
Got to make sure I hit that mute button. Yeah, absolutely. Hot off the presses. The regulation has changed to allow now 501c19 organizations as being the benefactor of your donations of the earnings in these accounts as well. These are more centered around affiliations or with the Veterans Association. A good could be the local VFW post, could be one, in which a lot of our communities have them. So it's really, I really appreciate and like the fact that they opened up this regulation, right? Because that's, there's always a good cause there, people for our country, and it just opens up another way for us to help out in those giving and supporting these entities.
Well said. I think it's so awesome. People love to support veterans. They're the reason why we're here, right? Not to go off on that road too much, but it's awesome to support them. And I looked into this a little bit. There are 29 different types of 501c's. Is that crazy? Got
21 of them.
29.
29 of them.
29. And so maybe in the future, you look those up and maybe we'll rally for some more to be added to the list.
Absolutely.
Yeah. So pretty neat. You can affect a nonprofit, you can affect veterans, a lot of impact here. So when you make your earnings from this account, you're increasing your earnings, you can take it and you can give it to those qualified charities. Also, there's incredible flexibility with this type of account. We have here listed, you have 5 years to give. There are several credit unions we're working with actually right now that they say, hey, I want this, I want to give more, I want to give to my community, but I don't really have the charities picked out. We're gonna have a conversation. No rush at all with that. You might have an idea, but you want to talk with your board, you want to talk with your team, even your membership, get some feedback from everybody. If you literally do not give anything away until year 5, that's absolutely okay. You have time to figure it out, but they do put a time limit on, so the money ultimately goes where it should go. Right.
Absolutely.
And as we wrap up here, you can just see the goal is to increase your earnings. We've already mentioned that a few times. So really similar products for different purposes. So now let's get into a comparison. We want to take some time and really compare the difference between an EBPA and a CDA in your standard portfolio. Most of you on this call, I imagine, are somewhat familiar with your standard portfolio. Maybe you work with it directly, maybe not, but you're probably aware that your institution has some investments out, apart from the loans that you do, right? A different type of asset. I really want to make sure that you understand the differences so that we can kind of frame what the goal is here and strategy. So first we'll look at the standard investments. This is a list of maybe not totally exhaustive, pretty good list of the different types of investments that you might have in your standard portfolio. So most people are familiar with CDs up here, certificates of deposit. Great yields right now, by the way. Different topic for a different webinar, but CDs, government agencies, treasuries, mortgage-backed securities, and so on. Really, these are great tools, but they're tools that are all under that umbrella of normally permissible. These are permissible investments for you in your standard portfolio. These are not necessarily the same type of investments that we're going to look to put in your alternative portfolio. Alternative, by the way, meaning EBPA or CDA, but it's good to know the differences. And when you look down here, one of the things I wanted to highlight was the credit ratings of the corporate bonds that we typically have inside of a standard portfolio. We have listed here triple B minus to triple A. And what we're talking about essentially is that from a policy perspective, this is the range at which we would consider these to be investment grade, right? And there's a reason why I'm pointing that out. Pretty straightforward stuff. Craig, anything to add on this page?
No, covers it really well. Like you said, it's not exhaustive. Like the CMBS and MBS and CMOs are typically going to be agency wrapped and secured, maybe a little added onto that, but yeah, pretty good list and explanation on standard portfolio here.
Very good, very good. And then let's move on. And what is the purpose of the standard portfolio? Well, it's to increase your yield over your cash. That's one thing, right? You, as an institution, you have a certain amount of cash. You lend out a lot of it or some of it when you can, when it makes sense to, right? When the loans are priced appropriately, and we can book good loans. But then you have maybe some excess cash. And right now, people are probably laughing and saying excess cash. What is that? Haven't heard of it.
Well, there is a little bit of a liquidity issue happening on some balance sheets, but you're right. It's I think loans are there to be had if you have liquidity to do them right now.
That's right. That's right. So in maybe more normal times, or as cash starts to stabilize, which we're seeing that a pretty good trend of that, you would take that money, you'd put it in a standard portfolio. And then really what that portfolio is for is to support the rest of your operations as a credit union, to support your liquidity position, to support your loan demand. And the way we do that is we do it through different structures. The most popular being a ladder. And a ladder is, you can think of, fingers like this. These are the different rungs of the ladder. Just flip them this way. And then we have year 1, 2, 3, 4, and maybe a 5-year part of your ladder. And these different parts of the ladder will support your business in different ways, right? You have the short-term investments that you have maturing and the cash comes back to you. You can give that to your members if you have a liquidity need, right? People want to take money out, you can do that. If you have a loan demand, you take that and you lend it out. And the longer part of the ladder is really good because it helps your stability with your earnings. You can lock in investment yields and you can protect yourself if rates kind of fluctuate. It's a really good support tool. Also, we mentioned barbell here, and that's just basically a short part of the ladder and then not much in the middle, and then a long part of the ladder, just like a barbell. That's how a standard portfolio works. And let's contrast that now with a EBPA or a CDA. The types of investments that we're buying in this account, they're not worlds different, and in some cases, like a corporate bond. And then there are some assets that really are totally different than what you might be familiar with in your standard portfolio, but probably familiar with in your own personal investments potentially. And so here's a list, again, not exhaustive. We actually have the word other down here to capture everything else. But we have at the top corporate bonds. So let's talk a little bit about corporate bonds. We had that on the standard portfolio list, but here you'll notice the difference is the credit rating range is different. And we have between double B, which is now in standard and Moody, S&P and Moody's terms, this is considered high yield, and the triple B minus, that's the bottom rung of what's considered investment grade in their terminology. What we're really looking at here is the ability to go just a little bit below your standard credit policy in your standard portfolio in order to achieve a significant amount more yield without significantly increasing your credit risk.
Sure. So is just a quick question on that.
Sure.
Is that came in and I wanted to just throw it out there so we don't save it to the end. Is
Hmm.
does this mean like when looking at say double B credits, any double B credit that comes along, an asset manager should just buy that double B credit?
Absolutely not.
Okay.
Absolutely not. Great question. So
Yeah.
you want to have your own opinion about these credits, and that's really important. And it's a really good question that came in, and we'll talk about the risks a little bit later and what to do. But to briefly answer that question now, you want to do your own underwriting a little bit like you do when you do a loan to a member. You understand that member, you know their income, you know their balance sheet, if you will, their other debts that they might have. And then after doing that underwriting, you come up with your own opinion, right? A member doesn't walk into your credit union and somebody vouches for them. And you go, we'll just do it.
Yeah, it's fine.
We'll just do it. You want to have your own opinion. So I'm glad you mentioned that. And also, it really depends on, it's a really good question for this year, in fact, because there are certain industries that are under a little bit more pressure and volatility. And we want to be very aware of that, like the banking industry back in March.
Yeah, it really got hit hard, right? Yeah, yields went way up, values went down.
And nobody knew what was going to happen next, right?
Yeah.
And so we're a bit out of that right now, but we still want to be aware when the appropriate time is to re-enter an industry that had a lot of recent volatility. And even if that credit rating is double B, we want to have an opinion on it. So awesome question. Anything to add on that for you,
No,
quick?
I think you covered it really well, Zach. Thank you.
Okay, awesome. And then we have preferred stock. So this is probably the line that most people are least familiar with. So I'll explain it. Preferred stock is somewhere in between a corporate bond and a common stock, or an equity, if you will. It shares some characteristics of both. It's a little bit of a hybrid. Some preferred stocks have maturity dates, just like a corporate bond, and some preferred stocks don't have maturity dates, just like a common stock or an equity. And the way that they are also similar to corporate bonds is they have they have a fixed dividend in the same way that a corporate bond has a fixed coupon, right? So it's very similar to fixed income. They tend to be a little bit longer in duration, something to keep in mind, of course. And their coupons, at least in this environment that we're in right now, they tend to be a lot higher. There's a lot of opportunity to grab very high coupons right now. That's the actual income payments that you're receiving from the common stock that you're the preferred stock that you own. So it's a good mix. A lot of people want to know where we're seeing value, and I'll throw that in here right now. We're seeing a little bit more value with corporate bonds than preferred stocks, but you really want to have multiple tools in your toolbox. So as those assets ebb and flow with the values, you're able to move where the value is. Also, they're in between those two when it comes to if a company were to have trouble and go into default, corporate bonds are closer to the top, common stocks at the bottom, and preferred stocks are in the middle. So from a corporate risk perspective, credit risk perspective, they're right in the middle. Now, ETFs, exchange traded funds, this is not something you're going to see in your standard portfolio at all. You're never going to see it, but most people are familiar. Basically, it's like a common stock, but they tend to track a index like the S&P. They can track a sector of the economy like consumer staples or technology, and they can have all sorts of flavors of ETFs. You can have big company ETFs, large cap ETFs, small cap, different country ETFs, all sorts of things. And really one of the benefits here is diversification across different segments of the market, broad exposure here. Some downsides are you got to look out for expense ratios, some management fees that come with inside that ETF. Similar is a mutual fund. Mutual fund is a little more actively managed, not necessarily tied to an index. And benefits are broad exposure, diversification. Some risks or some downsides are they tend to be pretty expensive. And then common stock can be a great tool because we're able to focus in and buy a particular company. And in doing so, you avoid those expenses, those expense ratios, and you can get a little more specific. Maybe you have a particular opinion of a company, and it's a great time to get into that company, or maybe that company has a strong dividend yield. It's a way that you can participate. So Craig, a lot of different options here is really what we're looking at. Anything else to add on this page here?
Yeah, it's just make sure I'm off mute. It really is important as you look through these options that you are describing for anybody that's considering to go into these, is to really take a little deeper dive and understand the risks associated with them. And that does go through, get covered when formulating understanding of risk, and we'll talk about process and procedure for implementation of these accounts and policy development. So don't let some of these things where you're like, whoa, I've always
Yes.
heard bad things about stocks, right? Don't let them scare you off at the moment. We'll talk a little bit about that later. It's all about an educational understanding risk and investing within those tolerances.
Very good. If it's on this list, doesn't mean you need it. These are just options. Really
Right on.
important to understand that. Yep.
Thank you.
So now let's look at the purpose here. We've really already covered this. I'll be very brief. The purpose of both of these accounts is we're able to utilize these different types of investments or a different category of that investment that we already are familiar with, like a corporate bond, and increase yield over your standard investments and sometimes even loans. Your loans, if you're not priced appropriately, you could really have higher yields sometimes. But we want to increase income, and by doing so, we offset our expenses. And whether that be your annual giving expense that you budget for every year, or your employee benefit expense that you have every year, it's probably going up. But in addition to that, you can offer better benefits, give more to your community. These are the reasons, these are the whys behind the accounts. Also, to contrast with the standard portfolio, they tend to take on a different structure. Why? Because the purpose is different. As I mentioned before, the standard portfolio's ladder is really there to have a constant stream of income coming off while balancing it with a little bit longer term investments. Here, we're less interested. The primary focus is in generating that liquidity. It's really earnings. It's earning as much money as you can within the credit risk that's appropriate. And so the duration of these accounts, although completely customizable, they can be whatever we want them to be. They tend to be a little bit longer. They tend to be closer to 5 or 15 years. Now, we'll look at the exceptions to that. There are definitely exceptions. You can have a 1-year time horizon, even shorter theoretically. They tend to be a little bit longer. Also, speaking of duration, they may not, certain investments may not have a duration at all because there's no maturity date, like a stock, right? So you have that component as well. And those are the main differences between a standard portfolio and an alternative portfolio. All right. So moving along, now here is a little bit of a PSA that I think is important. There are some portfolios that we see out there, and they are EBPA portfolios or charitable donation account portfolios, and they actually have standard portfolio investments inside of them. So we see these sometimes and we scratch our heads. We say, what's going on? Why are we doing this? So the PSA is this: if you have an EBPA or a CDA, or you know somebody, a friend in the industry has one, it's really good to take a look and don't make assumptions that this account is being utilized appropriately. Let's take a deep dive into it. And what we've done with several different circumstances is we've taken a portfolio, we've analyzed it, and actually we've discovered, wow, there's a lot of investments here that should be in a standard portfolio. So what do? We make sure they fit the standard portfolio's policy. We have a conversation, and then we talk about transferring those assets out into the portfolio that they belong into. And then we replace them with appropriate assets that are actually designed to be in these accounts, earn a higher yield, everybody's happy. And you could really save money with this way too. Standard portfolios tend to be a lot larger, so there's an economy of size over there. So getting them into that portfolio can save you money, and you just simply make more money with better investments. So let's utilize the program properly, and we can definitely help look at this. You may have one or the other, by the way. You may be here for the EBPA because you already have a CDA, right? So let's examine if you have one or the other. Let's take a look at it, make sure you're in the right stuff. Craig, anything to add to that, sir? Oh, unmute. Yep.
Yeah, one other question came along in the Q&A section there that we covered in 101, but since it came across, we might as well just address it right away because we're talking about both EBP, employee benefit accounts, and charitable donation accounts here. Is you went through the limits of 25 and 5% of net worth, one guideline, one hard. Can I have both? Is it now
Oh,
limited
yeah.
under, is it, they just said, hey, can I have both? And what are the limits if I have both?
Right. So there's gray. I love this question. I hear it all the time. And there's gray area here because again, the 25% of the EBPA is a guidance. So can you have up to 25% of your EBPA and also 5% of the CDA? Yes, but you want to communicate that up front with your regulators, with your examiners to make sure you understand the intention, that they understand your intention, and also that this really, while we're really diving almost 301, this is good stuff. So when you're thinking about an EBPA, you want to make sure that the earnings that you're getting out of that account that are greater than your standard portfolio. So the increase in earnings, we want to make sure that the increase in those earnings are not greater than your employee expenses. They almost never are. As great as these accounts are, your expenses are very large. So as long as we're making sure that we're not exceeding that, then you can have that conversation of going up to both of those limits.
Excellent. Thank you, sir.
Yeah.
Makes sense.
All right. So moving on, we have why now is a great time. Best movie ever? I mean, top 10.
They had hoverboards back in the, what was it, the 50s or 60s?
Something like, yeah.
That's it really did predict the future fairly well if you think about, Back to the Future.
Yeah, that's right. So not only a great movie, but the tie-in here is we want to take a little trip down memory lane. We'll see what's happened in the past, see if we can do a little forecasting into the future. So this is one of our favorite topics, right, Craig?
Absolutely. Because just remember,
Sure.
past performance does not
Necessarily dictate future results.
So let's just take a look at what we've seen.
Yeah, absolutely. So here we go. Here's a 10-year treasury, and this is the yield over a long period of time. And when we look at where yields are today, which is where this part of the green line over here, we have to go back 20 years almost to go back to the late 2000s to find yields that are similar. And you have to go back to the 90s to find yields that are significantly higher than where we're at right now. Now, the question is, of course, okay, yields are much higher than where they've been in the past, but are they more likely to go up or are they more likely to go down? Craig, up or down?
Well, just based on my calculations and what's happening in the cycle of the economy, I expect rates to come down a little bit, actually. It's not going to happen tomorrow, right? But in general, they're going to trickle down as we start to see the economy soften and inflation is starting to slow everything down. So it naturally will be coming down.
Absolutely, absolutely. You hit it. The economy softening, I think, is super important. So here's a yield curve. And the real quick explanation on this is when you see the short end of the yield curve higher than the long end, something's wrong. It's not supposed to be that way. You're supposed to be paid more money the longer term you lock it out. The Feds raise rates really high. When have they done this in the past? They've done it ahead of recessions. You could say that the inverted yield curve we have now has been one of the best predictors, although sometimes it gives false signals, of course. But it's been one of the best predictors of recessions. We can see that going back to 2005, where the yield curve was inverted. The red line's cash, the black line is 10-year. What happened? We went into recession. The Fed reacted by dropping rates, and then the rates across the curve came down. Same thing happened in 2018 and 19. 2017, and you can see over here, the red line is above the black line. Something is not right, and we expect, as Craig just mentioned, this is unsustainable.
Yeah, so prepare, right?
That's right.
Absolutely. And it gives us a good sense of where interest rates should be going, most likelihood.
So what can we do? We talk about this being great time, and it really is great time. And so we want to protect against down rates. We can do that with these types of accounts, because let's go back to that ladder, right? Instead of having a short-term ladder, we have longer-term investments. We can lock out yields. We can make sure that they don't have certain call features. So if rates go down, you're not getting your money called away from you. We protect against that, and we can really protect down rates. And also, they're really non-correlated with your other assets, to your loans and investments. Rates are high now. You're booking great loan rates, 7-8% loans. But if they go down, what's going to happen to our loans? A lot of them are going to prepay.
Yeah, you got the borrowers are going to have the propensity to prepay as rates go down, and there's no real payment protection to us on those loans. So it's we're going to have a lot of cash flow, or negative convexity, if you will, with that section of your assets on the balance sheet.
That's right. Refining into lower rates, not a good thing. So inflation is also increasing benefit expenses. That's why it's a great time. Also for nonprofits, it's harder for them to run their business too. Just like everybody else, things are more expensive. It's a great time to help them out. Non-interest income is shrinking. We've seen a lot of people cut fees over the last few years, overdraft fees, et cetera, non-sufficient funds. Let's offset that. Let's find ways to offset. And we all know about spread compression. As rates have risen quickly, your deposit costs have gone up, and asset yields have not gone up as fast. So we want to think about how can we add certain tools to the toolbox, and we believe that these accounts are a great way to do that. So great timing. Now let's get into some of the juicy strategy. Craig, this is probably the most obscure movie that reference we have. Do we know what this is?
I know they're playing. It's on the tip of my tongue. They're playing chess, and we have a genius here.
That's right.
Has a gift of playing it, but I can't remember the name of it.
So this is Bobby Fischer. You heard that name?
I've heard of Bobby Fischer.
Yeah.
He was a basketball coach for the Wolverines, right?
Oh, really? That's awesome.
Someone's going to correct me on the first name, I hope. But
right. So we want to have a strategy, right? Let's pretend we're this guy on the left. We're going up against one of the geniuses of chess. Even at that age, he was known to beat some of the best chess players in the world. This movie is Searching for Bobby Fischer, by the way. That's the name of the movie.
Okay.
I think I got that one right. And we want to have a strategy. Don't go in and sit down and say, how do I move my knight, right? Have a strategy, know how the game works, have a strategy, how you're gonna beat, you're gonna win at the game. So here are some ways that we want to envelop our strategy. We want to know what our goals and our timelines are at the very beginning. It's probably the most important thing. When we get these started, it's one of the first things we talk about in our kickoff call. We say, all right, let's reaffirm what our goals are. So here are a few examples of those goals. Number one, you might want to have a employee benefit account because you just want to increase your income indefinitely, which is a fancy way of saying forever into the future. You want to, why? Because you're going to have employee expenses as long as you're around as a credit union, you're going to have expenses. So we want to increase our income. And there's nothing wrong with this goal, by the way. You might be thinking, man, I need to have a specific goal. This is specific enough. It's great. And what we just need to do is determine what our expenses are. And again, make sure that our earnings are appropriate towards those expenses. You may also have a much more specific goal in mind. I hear this less frequently, but I do hear it. Hey, we have a CEO, or I'm the CEO, and I would really like to have a payout when I retire. I want something to work toward as a bonus that I might receive upon retirement, or maybe I want to have a specific income generated to me on a go-forward basis on retirement, right? I want to make X amount of dollars every year beginning in 10 years. Well, those are totally different goals. One is ongoing and one has a specific time frame. If we have specific time frames, we can back into specific dollar amounts. If we have both of those time frames and dollar amounts, we can then determine the appropriate size of the account and the return that's appropriate for you to reach your goal. And then it's just a matter of implementing that goal. When we look at the charitable donation account, somewhat similar. You can want to increase your benefit giving on a go forward basis, just make more money, give more to charities. Nothing wrong with that at all. I think it's awesome. Or you might have a specific goal in mind. Maybe you want to give to a local YMCA in 5 years. They need $100,000. It's been in planning for a while. You can actually plan towards that. And again, we back into that goal. What do we need to do today to get you to that goal?
A lot of people have used this charitable donation account as another means to help increase their donations to their own foundations that they've created, right? And kind of one thing that you did mention is all right, we are all giving to the charities that we like, and they want to earn more and they want to give more and do more benefit through using their foundation. They don't have to necessarily have those new entities identified right now. That
Yes.
that donation to the foundation, it already qualifies for that charitable donation, and the foundation can plan and work towards accomplishing, impacting their community.
That's awesome. I didn't think of it this way until now, Craig, but what if you had a goal of starting a foundation in 2 years, right? You could fit that in here. We could say, let's start a foundation in 2 years. Let's earn money, have some seed money for that foundation. And absolutely. In fact, we did an entire CDA webinar about that. If that's of interest to you, if you're listening to this, go back into our YouTube channel and check out a CDA webinar. We talked all about foundations. And
Right.
when you give to that foundation, it is a 501c3.
Right.
It qualifies, you take that money, and now the time limit has already been satisfied. The regulation's already been accomplished. You've given to a 501c3, and you can sit back and distribute that money to whomever and whatever time frame you choose to.
Yep. Good reference. Thank you.
Yeah, great stuff. Okay, let's keep it moving and look at other strategy considerations. So these are really important. We want to have appropriate duration, length of the investments. We also want to determine the amount of fair value, the different asset classes, have a policy in place, and do some education. We're going to talk, we've already talked a little bit about the education of the different asset classes, but we can dive deeper. We have material that we can share with you that describe these asset classes. You can pass them out to your different C-suite or whoever, finance people, board, all of that. And we really want to understand risks. So we're going to dive into some of that moving forward here. So when we think about the different strategies and the goals and the risks that we're considering, we really want to be cognizant of credit risk. As you mentioned before, Craig, you don't want to just blindly say it's rated whatever, so therefore I'm going to buy it. If it's my policy, I'm going to buy it. Have an opinion. We can help you with that. Obviously, we have a credit team that does great work. Be aware of how these accounts affect your income statement. And instead of speaking vaguely on that, because we're in 201, I'll give you an example. A little bit later in this presentation, we're going to talk about how a certain asset can affect your income, which would be pretty interesting. Some assets also affect your balance sheet, like they already do right now. You have investments that you mark as AFS. Those unrealized losses will affect your capital, but they won't affect your net worth, your regulatory net worth. It's just, we need to understand the differences, and that's got a little bit of a foreshadowing to the accounting section here. Also, interest rate risk, really important. It doesn't matter what the asset is. It can be an investment, a loan, standard investment, EBPA investment. They have interest rate risk associated with them, right? If you, for example, buy a bond today at 7% yield and all of a sudden yields are 10, well, that bond is worth a little bit less. But if investment yields go down, it's worth more. And the amount of income that you're generating is different than what you could be in the future. Interest rate risk, we want to consider your full ALM position as well. As a quick example to that, let's say you're looking at your ALM report that you get and you're saying, wow, we're really sensitive if rates rise. Well, it's good to be aware of, right? We want to have that conversation, maybe run some simulations and see maybe the appropriate duration for you in that particular example is to keep your assets a little bit shorter, so we're not straining that interest rate sensitivity you already have.
And you had mentioned about, going through policy and achieving setting goals. The other thing is the structure of your balance sheet or your capital position. That will
Mhm.
have a little bit of an impact on what you should be taking risks on. Meaning if you're having a lot of capital that you could have extra just laying in the desk drawer, right? You have the opportunity. It's similar like interest rate risk. You have the opportunity to take a little bit more risk if you want to, or if the board is comfortable with it, right? So some of that is that helps decide the factors not only of management and board's comfort level, but also structure of your balance sheet will help dictate whether you can or cannot take certain risks within these types of accounts.
Absolutely. And not just assuming, really running the analysis, stress your capital, right? Those are some of the things that we want to do. Make sure that your whatever capital you're at, that we can run different scenarios, and that's very important. So well said,
Yeah.
Craig.
Right on.
And we have accounting, and right here we're not accountants. That's the point, right, Craig? Are we accountants?
We are not accountants. We work with a couple of dozen firms around the country about issues. So we do understand what is important to know in these accounts with respect to what you're about to cover and valuation changes. But we are not accountants, and part of the process, in addition to policies and regulation and stuff, is talking to your accountants and working out what we're going to be doing, what we're thinking about in the asset classes.
Hmm.
How will it impact our accounting and our general ledger entries as well as valuations?
Absolutely. Yeah. And, we want to point you in the right direction. That's why we're bringing this up. I would say probably one of the biggest questions I get is regarding accounting. And I always joke, I say, hey, asterisks, right? We're not accountants. People get that. I had the conversation today about this very thing, but we can point you in the right direction. In fact, we can also connect you with people that are in your shoes that are already doing this. They're already accounting for it. They have systems in place. But just to get you started, probably one of the most important concepts to understand is the difference between what we call fair value and non-fair value. So that's the title of the slide, and we're going to talk about fair value. So fair value may be a totally different concept for you. It's different than your standard portfolio. What it is essentially, if you have an asset that does not have a maturity date, that means that we can't expect at some future date that to get par backed, to get that investment back at a certain price. So we need to account for it differently. Examples of that would be stocks. Stocks don't have maturity dates. ETFs don't have maturity dates. And certain types of preferred stocks called perpetual preferred stocks, they don't have maturity dates. So this is how this works from a high level. If you own an investment and the market value shifts from where you own it, the change in the market value from month to month, that change affects your income, even if it's an unrealized gain or loss. Okay. An example of that is right down here. You own Amazon stock at 100,000, it becomes worth 90. You didn't sell it yet. You haven't truly lost 10,000, but because you've marked it to market and are considering it fair value, you lose $10,000 of income. That's risk. That's a type of risk that we need to be aware of. Now, the opposite is true too. You could gain 10,000 and you would make that income as well. So the fluctuations are really important. And this is why, quite frankly, some people, it doesn't make sense for them to be in any fair value assets at all. And there's nothing wrong with that, but they do offer a benefit. In fact, one of the benefits is the intention of this double-edged sword. What that means is, even though it's a double-edged sword, you can make money or lose money on an unrealized basis that affects your income. Also, if you do have an investment that's underwater, you're use this Amazon stock example, you're underwater a little bit because you've already realized it. It's actually really easy to sell. You can rebalance very easily with these assets. Whereas if you had something that's available for sale, like a corporate bond, that unrealized loss, you haven't realized that yet. If you choose to sell it, you will be realizing it when you sell it. And that can be a little bit more difficult to stomach because, oh man, do we really want to realize this? The fair value, it's already happened, and it's easy to flow in and out of those asset classes. All right. Anything else on this page, Craig?
Nope, you covered it well. Good example there with the Amazon stock, right? I'm just going to go the other way now, though, right?
Oh, it's going up. You want to buy at 90. And then non-fair value, you're very familiar with this, most of you probably. They have maturity dates, so corporate bonds, non-perpetual preferreds, they only affect capital. It's what you're already used to. And they typically are accounted for as AFS. So within these accounts, you can have both, one, or just you choose one or the other, right? You can really customize this whichever way makes sense for you, and we'll help you guide you there. So now we get into communication, and this could be a few movies, right?
Yeah, I at first thought it was maybe Sleepless in Seattle or something of that nature,
Right.
but it's not, is what I'm seeing you shake your head no.
You know what, for my luck, because I searched for this, maybe it is Sleepless in Seattle, but I think it's You've Got Mail.
Oh, You've Got Mail,
Remember?
communication. Nicely done.
Yep. So we want to be able to communicate. Here they are. They're finally met after whatever. I saw the movie a long time ago.
This
I'm
is
not.
when email was a new thing, right?
That's right. Yeah.
Okay.
It was back when email was exciting because you only had 10 emails at a time. And it always said, "You've got mail," every time you walked in. So communication is really key, right? We want to communicate, very important. If you have internal management reviewing your performance reports monthly, they're doing the right thing. They should be in touch with what's going on with the accounts, and those are the types of reporting cycles that you would expect to have on these. Also, advisor and management, the way we handle this with our clients with these accounts, we set up quarterly meetings. We could do different time scales on this. We like quarterly. It's a good cadence, and we discuss performance. How are we doing? What's new in the market? What's going on with the economy? All of those things stay in constant communication. Also, documenting things to the board. Examiners' favorite thing for them to do is say, "Can you show me proof? Show me, I trust that you talked. Can you show me proof that you have discussed this?" So having appropriate documentation, documenting stress tests, documenting the policy work that we've done, the education, all of it, the more the better when it comes to that. And then on an ongoing basis, you want to have education with board members and management. We can tie these together too in quarterly meetings. Every once in a while, bring in a board member, have them sit in, bring in Alco, whoever you want to bring in, and then take that education and make a note to your board. And now at the end of the year, you have that proof that you've had those conversations and we understand what we're doing. It's really great. Now, reporting is one of the most important things to do too. And this is our good friend Tom Cruise. Craig, have you seen this one?
I have not seen this movie. That's Don't know what it is.
Sorry, I should have grabbed one that you've seen. So this is Minority Report, and
Okay.
it's a great movie. And the premise is he uses all these different analytics, this reporting, in order to track down what people are going to do in the future. So we want to have great reporting, not only what's happened in the past, but what we can actually expect in the future as well. And here are a few examples of that. Monthly performance reports. We took a few snippets out of the reporting systems that we use, and we want to have monthly reports that track performance. You want to have value reports, especially if you're in fair value, meaning what's the difference between where the market values were last month, where are they this month? Really important to track that. Prior income, what's happened in the past, really good at the end of the year. So you can say, these were my employee expenses. This is how much income I've made. Or charitable giving, this is what I made over 5 years. Now I know that I'm required to give X percentage of that away. But also the future, like I mentioned, projecting income, very important. So you can see here is a little picture of projected income. And we have the pretty pie charts of all the different allocations. And this example is actually by sector of the economy. You want to keep this very understandable. And this is one of my favorite pictures over here on the left that shows the difference between fair value and non-fair value. Customized reports for credit unions in this case. And we want to make it's a great tracking tool to make sure we're within policy and strategy. So moving on to the account opening timeline, it all begins with discussing and educating. And we flow through this all the way to the point of deploying funds. And that includes notifying regulators, making them aware of your intention, incredibly important, determining your goals, which we've already mentioned, doing a risk assessment, creating a policy and having it approved by the board. And then it's simply opening an account, funding it, having a kickoff call to reaffirm everything that we've talked about up to this point: strategy, policy, cadence of communication, and then finally deploying the funds and having ongoing meetings going forward. So here's a brief look at that. Craig, anything to add here?
No, I think some of the timeline can be added in different spots, meaning
Sure.
like notification of regulators, right? There might be some changes along the way. There might be some back and forth throughout that timeline.
Mhm.
But I think the other thing to think about is one thing you mentioned a little bit ago, which is extremely important, is that discuss and educate and the ongoing discussing and educating on an annual basis. I think as say your board slowly changes and rotates if you have one new coming on or a new management coming in, having them participate in annual education because there like you said earlier, there's a lot of risks involved and we're not mitigating entirely, we're managing risk when we're putting in these accounts in place.
I love that. Not just old board members, new board members. Everybody should be on the same understanding. That's great.
Yeah.
Very good. How long does this take? I'm sure someone's thinking that. Really, it's as fast as we can feel comfortable with the account, determine our goals, and get everybody educated. Really, as fast as a few weeks, but it can be pretty, it can be a little bit longer than that if needed. So common concerns, we're going to wrap up with common concerns. And you may have no liquidity, your board doesn't understand it, or you don't, or we don't have time to worry about this. Don't worry, we got you covered, and we're going to go through that really quick. So the best for last, Zoltar.
It is a movie I do know here. One of my favorite movies, actually. Big?
That's right.
Yeah, it's big. And Zoltar is the all-knowing and, leading him to the future and giving him what he wants, actually, by asking for it. So
That's right. It's a great movie for those who haven't seen it. So yeah, we want to provide some answers. Maybe we're not Zoltar, but we'll get you close. We have liquidity. So I don't have liquidity. You may have liquidity, actually. We can do a swap analysis for you. We've had a lot of success with this lately, like really lately over the last few months. And we can look at your standard portfolio investments. There may be really low yielding investments that we can swap out of and into higher yielding investments. Yes, there's a loss on sale. We can recoup that, talk about timeframes, and we'd be happy to look at that for you. Also, it's just okay to partially fund. You have a little bit of money, but you could go up to 2 million or 20 million or whatever it is. Do a little. That's fine. Start the account, get educated. That's the most of it. Then it's easy to fund the rest of it in the future. So great follow-up if anybody would like us to do this analysis for you. Management. Okay, do you want to mention anything on that?
yeah, I just wanted
Sure.
to manage. You had mentioned, it's a great environment to be booking loans, your 7 to 9% loan rates. And they do have that negative convexity, that propensity to prepay as rates go down. This portfolio, depending on risk tolerances, can get similar yields without that negative convexity. And so it's things that can recoup that loss on sale fairly quickly at those levels without as much negative convexity, meaning these assets will be around for a longer period of time than because no one else has that option to pay it off, to take it away from you. So very important when you don't have liquidity, you can still really, really have the opportunity to look at that and make sure the transaction can make some sense.
And that sounds like diversification to me. Very important. I love it. So management board doesn't understand, hey, this webinar might be a good tool. Maybe 101's a good tool, but we have a call with management, talk through, do education, and we can really help. So we want to discuss the value and make sure people know why we're doing it. You start with the why, then you talk about the tool, then you understand the tool and you implement the tool. It's really simple step-by-step process. We can help you with this for sure. And finally, I don't have time. I get it. You may not, that literally may be true. You don't have time, quarter end, budget season, all that. I get it. But we do the heavy lifting for you, right? So let us help. We can do the policy creation, do the help with the education. Yes, it's going to take you some time, a few hours of calls. Not going to lie about that, right? It's going to take some time, but you're going to have to find somebody that really understands this to get that heavy burden off of you. And we'll make that a lot easier. So really, let's end here with a call to action, and we want to help you, right? We're here to educate, and we're also here to help. We're not just talking theoretically. We manage these accounts. We have a lot of experience with these, a lot of success helping people earn more money to give to charities, to help pay for their employee expenses, and to overall increase income. So before I go to the actual last page. Craig, anything else? Final notes here?
No, just based on time, I think you did an excellent job. A lot of great content today. It's a great account that's been performing very well overall, and it is a great time to be funding and putting on earning assets in this high rate environment. The old saying is buy low, sell high, and right now prices are low, yields are high. It's just a great time to be looking at doing this. I want you to just
Absolutely.
jump forward quickly just to talk about there's some contact information. And remember, this webinar will be on our YouTube channel for people
That's
to
right.
use. And we were remiss to not mention the next upcoming webinar that's going to be coming over on the next page there. It's about our industry update for planning and budget season, which is pretty much starting right now.
Yes.
It's, by November hits, you should have your budgets done. So we're doing an industry update for planning and budgeting. It's going to be mid-October on the 17th from 2 to 3 o'clock. You and all of your staff are always welcome. Please share the information and registration availability for it, and you're all welcome to be a part of that with us.
And hey, how about we throw an EBPA and a CDA into the budget?
This
You
is
like
time to
that?
really think about it. Absolutely, that increased income. So thank you again, Zach. You did a great job.
Thank you,
Great
Craig.
information, very well laid out and explained. So, and thank you for everybody for attending.
Thank you. Thank you, everybody. Bye-bye.